Gold is at record highs, and there's one burning question. Is a crash coming in 2026? It seems like gold can only go up, but here's the twist. The rapid rise we're seeing could be hiding something much darker. The real risk isn't about how much higher it can climb, it's about what happens when the rules suddenly change. This isn't just about gold's price anymore. This is about your money, the global economy, and what happens when confidence falters. Stick around because the next twist in this story might catch you off guard. Now let's take a step back and look at where we stand. In 2025, gold surged by 64%. That's more than 4 times the rise of the S&P 500. To put it in perspective, the S&P 500, which is often seen as the gold standard of investment, went up by just 16%. Gold's performance wasn't just impressive, it was extraordinary, especially compared to everything else. But here's the thing, this kind of explosive growth is never without consequences. What happens when an asset like this keeps climbing year after year? And here's the question that nobody's asking. Could it all crash when you least expect it? Take a look at this chart. For the past year, gold's rise looks pretty steady, almost like it could go on forever. But now let's zoom out. When you look at the last 30 years, that steady rise suddenly feels a lot less secure. In fact, for most people, it looks more like a ticking time bomb waiting to blow. Gold can't just keep climbing forever, right? Or can it? When you step back and see how far it's come, the question isn't just how high can it go, it's when will it stop? The thing is, this exact pattern has played out before, and we've seen how fast things can turn. Let's take a deeper look at what happened back in 1980. Gold hit a massive peak around $850 per ounce after a decade of climbing, but then it collapsed by 65%. Now here's the key. Gold doesn't fall just because it gets too expensive. It crashes when people lose faith in the currency it's meant to protect against. Back in the 1970s, inflation was out of control and the public had lost all confidence in the dollar. Gold skyrocketed, reflecting that loss of trust. But then something changed. Under Chairman Paul Volcker, the Federal Reserve raised interest rates to a shocking 20%. Think about that. Imagine paying 18% on your mortgage, but that's exactly what happened. The Fed's aggressive moves crushed gold because suddenly holding cash didn't punish you anymore. People started trusting the dollar again, and gold lost its role as monetary insurance. But here's where it gets even more interesting. The situation today is completely different. Back in 1980, real interest rates were pushed well above inflation, a full reversal of today's scenario. Right now, inflation is still higher than the interest rates set by the Federal Reserve. For example, if you put your money in a savings account today, you're earning around 3%. But with inflation still running at 6% to 7%, you're losing money in real terms. This is what's called a negative real interest rate, and it's a key factor keeping gold's appeal strong. But under Volcker, interest rates were sharply positive, meaning cash started to hold its value again. Gold didn't crash because it got too expensive. It crashed because the dollar regained credibility. The big question is, can the dollar regain that trust today? And more importantly, can the Fed act with the same level of aggression? Now let's look at the sequence of events that followed. By 2011, gold was riding high again, reaching nearly $1,920 an ounce. But this time, the collapse wasn't immediate. It didn't happen in a single dramatic crash. Instead, gold entered a slow, grinding decline. By 2015, it had dropped nearly 45% from its peak. The question is, why? Well, just like in 1980, it wasn't because gold became too expensive. It fell because it lost its role as a hedge against financial instability. The global financial crisis and quantitative easing sparked gold's rise. But once inflation didn't surge as expected, gold's appeal started to fade. By 2013, the Federal Reserve started signaling that it would eventually end emergency policies. Real interest rates moved higher and the dollar strengthened. That shift in policy created a massive outflow from gold. Gold doesn't crash because it's overbought. It crashes when it no longer serves its purpose. So what does this mean for you? This isn't just some distant financial issue. The rise and fall of gold affects ordinary people, your savings, your purchasing power. When inflation keeps rising and interest rates stay low, the dollar's value shrinks. Gold becomes more than just an investment. It's a way to protect what you've earned. But if gold loses its appeal as a hedge against inflation, that means the dollars in your bank account lose value faster than you realize. If this feels familiar, say so in the comments, because this is more than just a financial trend. It's a direct hit to your purchasing power. How much longer can people ignore the pressure? Now let's look beyond the headlines and focus on what's really driving this. The system that allows gold to rise and fall is built on trust. Trust in the dollar, in the Fed, and in economic stability. But what happens when that trust is shaken? Gold isn't just reacting to inflation, it's responding to the underlying systems that support the dollar. Right now, we're in an environment where real interest rates are still negative, the U.S. government's debt is skyrocketing, and central banks are buying gold at record levels. The global financial system is shaky, and many countries are actively moving away from the dollar. This creates a structural demand for gold that simply wasn't there in previous cycles. It's not just about inflation anymore. It's about how the system itself is set up to fail. Gold has become a measure of how far we can trust our own financial system. And right now, that trust is under intense pressure. So what happens next? Well, there are two possible futures here. In one scenario, we see volatility and consolidation. Gold stays within a range, fluctuating but not crashing. Expect sharp corrections but no total collapse. This could be a painful roller coaster, but ultimately gold stays relevant as a store of value. In the other scenario, we face a sharp correction within a long-term bull market. Gold could drop 15%, maybe more, depending on market conditions or global events. But here's the twist. It wouldn't be a repeat of 1980 or 2011. A crash that big would require something fundamental to change. The big question is, what will trigger that change? Will it be policy, or is there something else coming? The real lesson here, gold doesn't fall because it hits new highs. It falls when the world regains faith in fiat currencies. And today's environment is nothing like the past. The difference is subtle, but it's huge. Gold's role as a hedge against systemic failure hasn't diminished. It's just waiting for the moment when the dollar can no longer perform its job. History doesn't repeat itself, but it sure does rhyme. If you want to know what happens next, make sure you're ready. And if you're interested in what I'm investing in and what I'm doing with gold, check out my Patreon for exclusive content. Subscribe now for more deep dives into the future of gold and your money.